started. So, all right. So typically on the first call, I'll start off by building mental frameworks. Some of these things will be things you already know, but it's just a matter of reiterating it and making sure that it's a part of our everyday thinking. All right. So,
All right.
so initially, right, we both know, right, in order for price to go higher, it must take sell side liquidity. All right. We understand that.
Yeah.
All right. Of course, under that low, price will go here. All right. And then for price to go lower, it must take buy side liquidity. Okay. Simple stuff. All right. If you were to say, hey, Chris, how does price move? Like, what is price's movement on a day-to-day basis? I would tell you that price literally moves from buy side liquidity and it reprices to sell side liquidity. All right. It creates imbalances and then it rebalances. Okay. So basically, here we go. Buy side liquidity, sell side liquidity, creates an imbalance, and then rebalances and then continues. All right. So that's that little, little mental framework there. All right. The next mental framework is understanding that price, right, literally moves from stops to inefficiency. Right. And then I would attribute this to trending markets rather.
Okay.
All right. So in trending markets, we understand that price is going to go from stops to imbalance, then imbalance back to stops, constant cycle. All right. Now, to some degree, right, price is going to reach a higher time frame array, and we're going to get a reversal, and that's when we're going to see price is going to trade stops to stops. All right. So just to add a visual to that, we know that if price is trading stops and efficiency, stops and efficiency, stops and efficiency, stops and efficiency, stops, it's only doing that to reach some type of higher time frame array, right? And in this case, if we're straighten this drawing out. Okay, so if you're looking here, right, what you should see is from a higher time frame perspective, a more macro perspective, we've traded here and we've taken out stops, right? So then the draw becomes inefficiency, which is this fair value gap. Okay, now, of course, at this point where a lot of people fail is, and this could be any time frame. This could be a 5-minute time frame trickling down to a 1-minute time frame here, where this is 1-minute delivery. We'll just make this a new color just to symbolize that this is a lower time frame, right? And on that lower time frame, once again, price is literally going stops to imbalance, stops to imbalance, stops to imbalance, stops to imbalance. And then we're going to have an imbalance here, right? So now, that price trade stops to inefficiency. We've just met a higher time frame inefficiency, and we're not just going to blindly trade this level, right?
Right.
We're going to allow price to tell us. We're going to allow response. So let's pause right there for a second. Let's add in the next mental framework, and then we're going to come back to that.
Okay.
All right. The next mental framework is understanding institutional order flow, which is one of the most important things in price that a lot of traders don't necessarily pay attention to. Right. So we have institutional order flow, and then this kind of blends into market maker buy and sell models.
Okay.
All right. So there's only ever a sell side of the curve and a buy side of the curve. right? Key points for the sell side of the curve is that on the sell side of the curve, we're going to see up close candles support the direction of price. All right. On the buy side, down close candles will support the direction of price. Is that clear? All right. Now, on the sell side, in addition to up close candles supporting the direction of price, what we're also going to see is that the down close candles will be easily traded through. And this is where we say, low resistant liquidity runs.
All right.
Right. So they'll be traded through with least resistance.
Chris,
Mhm.
The recorded session, are you going to share the video with me?
Yeah. Of course.
Perfect. Thank you.
Yeah, of course. All right. And then on the buy side of the curve, of course, up close candles will have the least resistance.
Uh-huh.
Right. So let's just kind of highlight those things. All right, cool. Now, so we understand institutional order flow. On the sell side of the curve, up close candles are going to support the direction of price. Buy side, down close. Just to come to a chart really quick, just to show you what I mean. This is honestly everywhere. If you look right here, right? When price was coming down, and this is more of a linear move, so it's not a lot of up close candles, but either way, when price is coming down, if you see this as one candle, right? What you're seeing is you're basically seeing up close candles are supporting the direction of price. All right. When price reaches that, it took out a previous day's low. Once it reaches an array, all right, or that definite terminus, then what you're going to see is a change in order flow, right? So what do you start seeing here? Down close candles begin supporting the direction of price, right? Right. So price is not necessarily turning through down close candles. If you look at the up close candles, least path of resistance. Okay, you see that?
Yeah.
Right. And then if we go, let's go to a daily chart. If you look here, all right, so now we're going to pay attention to the sell side of the curve. Now look at this. You're seeing these up close candles, right? Basically supporting the direction of price. Right? Price makes it down. This area is a quarterly inefficiency. I'll show you. Price makes it down to this inefficiency. Right? Makes it to an array, and then watch what happens. All right, so it makes it to that array, and now we have to decide if we're now transitioning to the buy side of the curve. What candles support price on the buy side of the curve?
The down close candle?
Yeah, exactly. Down close, right? So what we're seeing is price leaves these down close candles, supports here, right? Trades up. This is the first instance where it negates an up close candle. All right.
All right.
Then it comes down as a response. So it negates an up close candle, right? And then the origin of price that led to it negating that up close candle, price literally comes back and it unders that price point. So it's like up close candles take the day off, down close candles show up for work. Taking it out, right? Then we also take this guy out, right? If you look here, price literally trades stops back down to imbalance. From imbalance, back to stops. Stops, imbalance. Imbalance, back to stops. See that?
Yeah.
Right? And so we're combining that with our understanding of institutional order flow. Down close candles are continuously supporting price. You see? Right? Yeah. And these up close candles are easily being taken out because we're now on the buy side of the curve. All right, that is highly important. That's a universal concept. All right. Now, to kind of amplify that understanding, take your attention to right here. All right. Because down close candles get taken out, right?
Yeah.
So you might say, oh shit, I thought you said on the buy side of the curve, down close candles should be respected. This one is taken out. True enough. You have to understand every now and then price will have to sweep liquidity. But how do we decipher if it's a liquidity sweep or if institutional order flow is actually changing over? The way we decide that is it's always cause and effect. If a down close candle is taken out, I need to see that the origin that led to that being taken out, I need to see that that area remains respected. All right. So the moment we then go back here, all right, then now we know institutional order flow is that this was just a liquidity sweep. All right.
Yeah.
So even here, we respect that, come down, and then we trade back above it. All right. So institutional order flow, we know that this is all just a liquidity sweep. All right. So basically, you continue to see down close counter support and price. Same idea here. Sell side of the curve, up close candles, right? Down close candles are easily taken out.
Yeah.
Then once we meet an array, we come to a weekly, on a weekly chart. You see how this down close candle, buy side of the curve, it does not give away. It holds. This one holds. See that? Yeah. Everything over here, up close, easily being taken out. All right. So I'm expecting that to be taken out at some point, until price proves to me that there's a change in order flow. All right. Now, so then we get inside of that weekly candle. And then now we're going to switch to the buy side of the curve. How do we know that? Up close candles start getting taken out. Now down close candles are showing up for work. See that?
Yeah.
All right. So every time before you take a trade, you should always ask yourself, right, am I trading against, like, if you're shorting, am I shorting on the sell side of the curve or the buy side of the curve? Yeah. And if you're shorting on the buy side of the curve, low probability, right? So, all right, so we have that. All right, next thing, just to be an additional piece to that is understanding that as traders, right, we only care about these points right here. Here, 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 here. Okay. Why? Because at those points, price changes its stated delivery. All right. Most people are waiting on this break of structure when that is the effect. Well, if that's the effect, there has to be a cause. This is the cause. Exactly. Right? Because on the lower time frame, you got to understand this is going to be stops and efficiency, 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 stops, buy side of the curve now. Right? Then we take out liquidity. Obviously, there's going to be an imbalance in here somewhere. Yeah. Then price goes to the sell side of the curve. Right? We take out down close candles, up close shows up for work. Boom. Stops. Now we go stops to imbalance on this side, buy side of the curve. Simple stuff. Okay. So now advancing from just saying CSD, we understand that the change in this, the change in state of delivery is the order block. All right. The change in the state of delivery is the order block. That is how the algorithm communicates the change in state, by way of the order block. Why do you say that, Chris? Well, think about it. The order block is literally this down close followed by this up close that trades through that down close is high. Right? So if you think sell side, buy side. See that?
Yeah.
Okay. So if we can get good at mastering the delivery that creates this, kind of like you said earlier, the delivery that creates this, then we don't have to worry about a break instruction.
Yeah.
All right. Okay. So one more piece. Having a brain freeze. All right. All right. Okay. Cool. All right. So we got that order block, changing state of delivery. You got that understanding. All right. We can come back over here. Okay. So now we know that price trade stops to inefficiency, All right. Well, when it trades to this inefficiency, we should go inefficiency to stops. All right. But instead of us blindly trading this area, now that we know enough about institutional order flow and we see price always in the regard of sell side of the curve, potentially buy side of the curve, we're going to now wait on the response.
Response.
Exactly. So instead of trading the key level, we trade the response at the key level. Okay. So price trades down to here. All right. Behavior before was stops inefficiency. At this point, it trades here. If this is our inefficiency and that body of that candle closes inside of that and it closes above that inefficiency, all right, boom. Now, this should basically be an alarm to us. Okay, something different is happening here.
Yeah.
Right. And then obviously, if we think about it up here, you're going to have up close candles, right?
Yeah.
So let me just kind of make this come to life a little bit. All right. All right. So we close in inefficiency. That's a sign. Price trades higher. Right. We take out a up close candle. Right. Now, instead of stops in efficiency, we've just traded stops to stops. Because at this very moment, when price closes in that inefficiency, and you already understand this at this point because you've been in the group.
Yeah.
Price has basically said these two, because price only has two choices, right? When it closes that inefficiency, it just said screw the imbalance.
Yeah.
Right. And then now we're going to have some type of imbalance here. And we can officially say, after respecting the down close over here, right, as a response to negating the up close, now we're on the buy side of the curve. Right. Targets are buy side liquidity. All right. I'm sure that makes sense, right?
Yeah.
Cool. All right. Now, if you notice this area, this is going to bring us to the next piece and the most important piece of this lesson. This is sell side liquidity, and this is buy side liquidity. Right? We bring this to life a little bit. All right. All right. So if price takes out sell side and buy side, what does that give us? I'm sorry, that's not buy side.
Yeah, a new trading range.
A dealing range.
Daily.
Dealing range. Right. So let's talk about dealing ranges.
And a dealing range, it's a new fractal. We could say that.
Yeah, you can say that because it has a short-term low, intermediate, short-term. So it basically creates a swing low, right?
Oh, yeah.
Got here, and then here. All right. So lesson 2, when we talk about market structure, and not the traditional market structure, because we don't necessarily use market structure, but we'll talk about, you know, intermediate, short term, and we'll talk about all that stuff. But a dealing range, characteristics of a dealing range, right? I'm going to give you the simplified version, and then we're going to break down or just reverse engineer, right? And then we're going to go and talk about the more amplified version. So the dealing range, right, is a sweep. By definition, is a sweep of buy side liquidity and sell side liquidity. Okay. So we have a range. Right. And it's not subject to a consolidation, but at this particular point, we have a range, right? We have stops above, stops below. Okay. Now, when price does this, right, that means it just traded took out stops, took out buy side liquidity. So if we're bullish, we'd be thinking that, okay, cool, it's just going to trade to inefficiency and then back to stops, right? Trades up, meets some type of higher time frame array. Boom, closing stop run. All right. So sweep of both buy side and sell side liquidity. All right. The next characteristic of a dealing range is displacement. All right. Earlier we talked about the fact that price moves from buy side liquidity, sell side liquidity, creates imbalances, and then rebalances. All right. So we went from buy side to sell side, we created an imbalance, and obviously we're going to rebalance and then trade back out. Okay. All right. So another thing to remember is going back up here, and then we're going to come back to dealing ranges, and then we're going to just continue to talk about dealing ranges. But keep this in mind. Retracements pair up with imbalances. Reversals pair up with stops. Perfect. Beautiful. All right. And retracements, to some degree, lead to continuations. All right. So just going over here, when price says screw the imbalance, then we know that this is probably not a retracement. This is probably a reversal. Right. All right. So let's kind of dig deeper into this whole dealing range idea. All right. And then one more aspect, understand that price is going to trade external range liquidity, internal, and then internal. All right. If I'm sure maybe you know what that means.
Yeah.
Okay, cool. Just for the sake of the recording, internal, external, everything inside of here is internal.
Outside.
Everything outside is external. Perfect. All right. All right. So let's imagine that we're looking at this market, and this market trades and it takes out this sell side liquidity pool, right? And leaves behind this area of fair value. All right. One thing to remember, that markets seek fair value. Okay. Yeah. So if the markets only seek fair value, right? So markets trade fair value premium to discount liquidity, right? Or discount array wrap, right? So if markets seek fair value, right? That means once it reaches fair value, which is its only objective, it should turn around and then seek discounts, all right? Or maybe fair value and discounts or liquidity, right? If that's the case, then what that means is price has to change states of delivery, all right? So one rule of thumb is understanding that order blocks, coming back over here, order blocks form in areas of fair value.
Okay.
right? Simply because if that's fair value here, when price reaches fair value, it's going to change states of delivery. Boom. All right. So let's come back down here. All right. So that's our area of fair value, but that's not the biggest point. We'll come back to that at a later lesson. But price trades takes out these stops.
Yeah.
And then we get this little range here. All right. Just notice this range. Within this range is pretty much a liquidity void, right? So if it's a liquidity void, and we know that in order for price to go lower, it needs to take out buy side liquidity. What price is going to do is going to engineer short-term lows, short-term highs. Sorry. All right. So we've just engineered these short-term highs, which is why I always say, hey, don't ever take the first swing back inside of a range. Right? Because you need to be patient and allow price to engineer its own liquidity. ICT says that price engineers liquidity, it neutralizes it, and then it redelivers. All right. So we're going to engineer, all right, which is this is giving us our range. Okay. That's giving us our range. Then boom, we tap into this imbalance. Displacement lower. Right? At this moment, we can solidify this as what?
Daily range.
Exactly. Why?
Because it takes buy side liquidity and sell side liquidity.
Yes, beautiful. Exactly. Right? We've taken buy side and we've taken sell side. All right. Now, we know that price moves buy side liquidity, sell side liquidity, creates imbalances, and then rebalances. All right. So obviously, if we got a displacement just means an energetic move away in price. We're going to have an imbalance right here. Right. So we move buy side liquidity, sell side liquidity. We created an imbalance. The only last thing we need to do is what?
Rebalance.
Rebalance, right? Rebalance this range. Okay. So we're going to see price trade back inside, takes out this buy side liquidity pool, the short-term high, takes that liquidity, and then trades back to external range liquidity. All right. So we've just gone external.
External.
Exactly. All right. Now, what happened on those? So let's actually remember these. All right. So we got 1, 2, 3, 4. 1 external, 2 external, 3 external, 4 external. What did 3 and 4 do?
About what?
3 took out buy side liquidity.
And 4 sell side liquidity.
So by definition, what does that give us?
Creates a new daily range.
Yeah, creates a new dealing range. Perfect. All right. So now if that created a new dealing range, then technically speaking, because price is fractal, this
should be 1.
Exactly. This is the new 1. This is the new fractal 2, right? And so now we're expecting, because price trades from stops to imbalance, obviously there's going to be an imbalance in here, right? So here we go. Price trades higher. Taps into the imbalance. Now we got our 3. So 3 is always the phase where price is rebalancing. 3 is a retracement. Retracements are paired with imbalances. All right. 4 is a continuation, or in this point, a slight reversal from a more fractal standpoint. And reversals are paired with stops, right?
Stops, yeah.
Right. Now, think about this. These are stops also, right? What price does is it takes out this internal range liquidity pool. And remember, 4 should always take out 2, right? So if we want to kind of consider this a complete dealing range, 4 should always take out 2. All right. Now, when 4 does not take 2, so that's obviously there's going to be an order block over here.
Uh-huh.
All right. Order block over there. Price trades higher. All right. If 4 doesn't take out 2, all right, and instead takes out 3, which is, so this is sell side liquidity, and this is buy side, we now have a new what?
Dealing range.
Yes, and this time a bullish dealing range.
A bullish,
right?
yeah.
Exactly. Right. Now, if 4 fails to take 2 and it takes 3, this signature in price is what? We only it's only
change the state of the delivery.
Wait, true enough, but
Failure swing.
Failure swing, exactly. Good job. Failure swing, right? So if let me move this out of the way. All right. If 4 fails to take 2 and then it instead takes 3, right? The draw becomes 1. Right? Because we just took that low failure swing. Now we're going to go stops to imbalance. And then boom.
Stops.
Right? So now one thing I want you to understand is that at each of these points, price does what? Changes its state of delivery. Right?
Mm-hmm.
And if it's changing its state of delivery, it's creating an order block.
Yeah.
Right? Meaning we don't have to wait on structure if we know how to trade the delivery that gives us the order block. Okay. So what I'm going to do is I'm going to take this. Let's move this out of the way. Right. And we want to be able to capitalize from each of those points. Right. We don't want to always have to wait on the structural break, come back to rebalance, and then, you know, we don't want to wait on that all the time. All right. Because we should understand the areas in which price should change states of delivery, which are areas of fair value. Right. And of course, you know, pools of liquidity. Right. So if I were to draw these 4 candles, right? If I draw these 4 candles, I'm going to add some color to it. All right. On any given day, let's move this shit down. All right. On any given day, any trader in their right mind is going to see this as an order block, right? They're going to want to see a market structure shift, and then back to the order block, and then they're thinking that, right? But sometimes, most times, price just does that. Why? Because it might have only been wanting to take out that low, right? So what I'm getting at is, if we clear this, and let's just draw the delivery in these candles right here. All right, the first candle opens, creates a low, creates a high, comes back, closes. The next candle after that opens, creates a high, trades lower, closes back inside of the range a little bit. The next candle opens, trades lower, and trades back higher. All right. We stop at that point.
Daily range, a new daily range.
Exactly, right? That delivery just is the dealing range, right? It's the same shit, isn't it? So let me try to draw this to scale. All right. So Now, and the next candle does what? Opens, rebalances, boom. So if I take these candles here, and I do this, it's the same thing. It's the same thing, right?
Yeah.
All right. So that equals that, that equals that, right? It's all just delivery. All right. So regardless of candles or anything, if I take this, place it back here, it's the same thing. All right. We could be looking at a daily chart. Blue could be a 15-minute chart, right? Each of those candles could be 1 day. Kind of got daily profiles right here.
Perfect.
Yeah. So, and then if you think about it, from even more fractal standpoint, look, buy side of the curve, change state of delivery, sell side of the curve. Right? Now, and then one additional piece is you have to understand this here. We want to get to the whole reason of this mentorship so that you can do that there, that there, that there, right?
Yeah.
Because what time frame is this right here?
Not sure.
It's a trick question. There is no time frame, right?
Yeah. Because
no
price is fractal.
Price is fractal, right? And all that is delivery, right? We understand that it's just delivery, okay? So let's go to a chart. We'll look at a few examples of dealing ranges, and then we'll wrap the lesson up. I'll give you some homework, and we'll build on this for the next lesson, all right? So for starters right here, if we look, what you see is prices taking out stops, and then we trade back up to an inefficiency, correct?
Yeah.
Right? Then we trade lower, we take out stops, and then price is going to seek an inefficiency. Okay. So now, in seeking this inefficiency, this area, if you look here, we said that order blocks form in areas of fair value, right?
Yeah.
All right. So market seeks fair value. Reason this is fair value because buy side is offered, sell side is offered. And then at this point, there's only sell side offered. So price needs to offer buy side at that point. Okay. So yeah, I had an entry on pound USD this week that was based on that. All right. So when we get to this point, you already understand that this is fair value. If markets seek fair value, if we made it to that bus stop, then we should continue in our direction, right? The only way we continue is by changing our state of delivery. All right. Now, so let's pause on that and let's look here. This is a little accumulation, right?
Yeah.
Right. That, you see that move there? I forgot to go into the amplified version, but we'll go into the amplified version of this on the next lesson. You got the beats over there, man.
Yeah.
It's all good. All right, but look, so we have this little inducement. This move here is kind of one of the most important pieces. This move here is basically just trapping anybody that wants to go short too soon. All right. So they're trapped, and then it just builds up more buy side liquidity. All right. But anyway, we have that initial range. You can see your consolidation.
Yeah.
Boom. Price takes out buy side liquidity, right?
Yeah. And then sell side.
So sell side, it creates an imbalance, and now it's going to rebalance. See that?
Yeah.
Okay. So from this here, so this is 0.1, 0.2, 0.3, 0.4. You see?
Yeah.
So now if you pay attention to this here, price gives us the new dealing range.
Yeah.
So inducement, take out buy side liquidity, take out sell side. So this becomes a new 1. This is your 2. 3 is a retracement, right?
Yeah.
Retracements are paired with imbalance. That's 3. And 4 should always take out
2.
Right. What happens with 4 right here?
Failed.
And it took out 3.
Buy side.
Yeah, took out 3. So this becomes a failure swing. Now the draw becomes
3.
1.
1.
Draw becomes 1. Remember, if 4 failed to take out 2 and instead takes out 3, you have a failure swing. That means we're switching bias. Price is going to take out. See that?
Yeah.
Now, this is a daily chart. Imagine being able to know where you are in a pricing sequence. So you're able to short here the entire time, buy here the entire time. You're shorting here the entire time. You're understanding here we took out 3, retracement, we're long. This is why if you were in the group a while ago, we were calling DXY in October down to the monthly imbalance that it's in right now because of this, right? And then you see price changes to the buy side of the curve, right? Are you good on time?
Oh, sorry, what?
Are you good on time?
No, I'm good. Don't worry about time.
Okay. All right, so look at this area here, right? Even if we get a little more fractal, if you take these 2 candles, price takes out the high, takes out the low, has an imbalance, rebalances, and boom, perfect. Then you would understand that this is phase 3. So guess what? Same idea. Take this candle, price takes out buy side, sell side, rebalance, boom. Now, remember this black line was that quarterly inefficiency, right?
Right.
Okay. Price taps into that inefficiency, right? Which provides the opportunity for a change in state of delivery. All right. It pairs up with this right here. And when we come to a 4-hour chart, look right here.
Okay, buy side, sell side, balance. Yeah.
You see that? 1, 2, 3. Now, guess what? This is 3. We're not taking a blind entry. We never do that.
All right. Yeah. Okay. All right.
What we do, and also let's pay attention to institutional order flow right here. All right. Up close candles taken out, right? Then we're seeing price trade down to a down close candle and potentially respect it. All right. Even right here, it traded above that, back down to it, and then boom. But we know this is 3, and we're expecting a change in state of delivery. All right. This is a market maker buy model. Let's go to a 10-minute chart. Now, you're seeing this, you already understand you're inside of a higher time frame dealing range. This is 0.3, which is a retracement. Retracements are paired with imbalances, and retracements lead to continuations. Okay. So now I want to, hey, algorithm, prove to me. All right. So 1, this is the market maker buy model, original consolidation, smart money reversal, and then it continues on. We'll go into the rest of the pieces later on in the mentorship. But if you look here, 1, 2, rebalance, 3, boom, right? We're targeting this and potentially even higher. See that?
Yeah.
Right? Right. Let's look at a few more and then we'll finish up. All right, look, there's a ton of them in here. All right, 1-hour chart. Here. Boom. 1, 2, rebalance, 3, boom. See that?
Yeah.
Let's come over here. Sell side, buy side. See that?
Yeah.
Let's zoom into here though. So we know that this is phase 3. This right here is going to be like what we the first example. So we know this is phase 3. Price should rebalance and then continue, right? So instead of taking a blind entry, we can come inside of here. So you already know this is phase 3. Remember what I said, price will engineer liquidity, neutralize it, redeliver.
Can you?
Boom. We'll look at 2 more examples from this week. All right, last 2 examples. All right, so look at this right here on the 15-minute chart. We had this and this, right?
Yeah.
Rebalance. Allow price to engineer liquidity, neutralize it. You see? So look, 1, 2, and 3. But guess what? Price creates another dealing range. 1, 2, 3, 4. See that?
Yeah.
We then take out previous week's low. Our buys come from here. Price takes out 1, 2, 3, 4. See that?
But in this example,
yes,
why
sir.
is the dealing range that one? I mean,
Here.
Yeah. Why it's not the yeah? Huh?
It is. It's fractal. 1, 2, 3. Right? It's fractal. It's fractal. Right?
Yeah.
So yeah, that's why I say this one thing here, this is what originally opened my eyes to how markets are delivered. Because if we learn to focus on high probability pricing sequences and we identify what that is, right? Then we gain an edge and we know where we are in certain phases. Okay. And then you can look here, sell side of the curve, up close candles, support and price. At this moment, we reach previous week's low. We take out up close candles, down close candles start showing up for work. Right. But I'm just taking this because is this a low and that's a high, right?
Yeah.
All right. All day long. Right. So if that's a low and a high, if price takes out the low, and if it takes out the high, by definition, I have what? Exactly, right? We take out sell side, we take out buy side, we create an imbalance, we rebalance, right? And then we continue.
Yeah.
See? So I took buys here this week, and I held it for about 60 or 70 pips. Wow. I didn't hold full volume though. I think what did I pull out? I want to say I took a good decent portion here, and then yeah, I should have just held. But it's all good. So yeah. So that is if you can even see it here, that's a low and that's a high, right?
Yeah.
It's everywhere, bro.
It's everywhere, yeah.
All right. Look. Oh, this is the best kind. See the inducement? See, we trap anybody that's ready to get short too soon.
Yeah.
Opposing stop run, reversal, right? This becomes my dealing range, right? Remember, market seek fair value, right?
Yeah.
This is your area of fair value. What happens at fair value? Order block forms. 1, 2, 3, 4. You think you can get good at this?
Yeah, I'm amazed.
All right. So that's it for lesson 1. Now everything else will literally be a building block to this, right? And you'll see how everything that we just talked about, everything else will literally be built around understanding that delivery. All right. For homework, what I want you to do is I want you to come to a chart. It doesn't matter the time frame. I want you to condense the chart like this, right? And I want you to find 10 bullish dealing ranges and 10 bearish dealing ranges. Okay. So, and the reason I want you to condense the chart is so that you're not focused on green, red candles, imbalances, anything like that. I want you to truly understand that this is about delivery. So I want you to come to that chart, see that low, see that high and that low. 1, 2, 3, boom. Right. Even this here, this is a dealing range. All right. All right, I'll let you go, man. I'll send you this recording, all right?
Perfect. Thank you very much, Chris.
Cool. All right, brother. Thanks for your time.